So what is the number one thing you should not do?
I was going to say the number one thing you should know is actually know the ticker, right? It's FB. F is in Frank, B is in boy. It's not face, it's not book. But you said the first thing you shouldn't do is buy at the open. A lot of these stocks will pop at the open, but they end up lower over the course of the day. That's what we saw what happened to LinkedIn, which we saw what happened to Groupon. Even Google at certain points of the day traded below its IPO price on the day its IPO. So you don't have to buy the second the market opens on May 18th or the second that Facebook starts to trade on May 18th. So that's the first thing. Don't pull the trigger right off the bat.
And there's no chance that you and I and individual investors are getting their hands on the actual IPO. We're not getting this thing.
Those are all going to institutional investors or big mutual funds that are already locked up with their brokers, a certain amount of shares. I mean, yes, if you perhaps have $5-10 million at a Merrill Lynch or Morgan Stanley world, maybe
they'll throw you
a share or two. But otherwise, if you're a Joe individual investor, you're probably going to have to wait a couple hours anyway.
Yeah. Okay. So the next one, use a limit order. What is a limit order?
A limit order tells the market that you're willing to buy a stock only at a certain price. You're not willing to take what the price of the stock is trading at the moment. You can set the price, and if the stock never gets to that price, then you never get the stock. But you can actually set, let's say Facebook was trading at $30 a share on that particular day. If you wanted to say, I only want to buy a stock at $29.50, if Facebook stock goes to $29.50, your order gets filled. Otherwise, you don't get the stock. But this is a way, just in case Facebook's price does skyrocket and you decide you're looking at it at $30 a share, you put in a market order, suddenly it's 32 or 33 and you weren't looking, you're stuck with a stock you just paid 10% more of.
Now, there are some issues with this limit order stuff, right? One is how long is the order valid for, and the other is when you pay for the order, it's different. It costs you more to make that trade than for a market order, right?
Yes, most of the time commissions can be a little higher as well, and then that market order is set over only at most a day, if I remember correctly.
Okay, so you might need to do it the next day if you don't get it filled.
That's right. Mm-hmm.
What about other ways to participate in the frenzy over Facebook? Like, for instance, there are a couple of ETFs that track social media products.
Right.
Is that a good alternative investment if you don't want to risk the IPO frenzy?
Most likely that they're so diluted with other technology names, or by the time some of these IPO ETFs get Facebook, it's several months after the fact. So if you really want to buy Facebook, just devote, and one of the things we suggest, a small amount of money, we're not talking 100% of your portfolio, but a small amount to the actual stock. And also, most importantly, don't be afraid to take profits. I mean, yes, there are all these great projections that Facebook could grow its profits 100% a year for the next decade or whatever, but if the stock's up 80% in 6 months, take some money off the table.
Nobody ever went broke taking a profit.
Buy a nice steak.
It's always a pleasure. Russell Plurman of Smart Money.